Hello and assalamu alaikum everyone. So in today's lecture we're going to talk about the last few remaining sources of finance. Sometimes these are called long term or short term, but it all depends on how you use these sources. So these are not specifically some long term sources, but yeah, generally it's used for some long term purposes. So these sources that we're going to talk about in today's lecture are the leftover ones, that is venture capital, crowdfunding and grants. So without further ado, let's begin. First, we have up is venture capital. What is venture capital? It is basically a finance given to entrepreneurs in need of money or capital, especially startup capital or expansion. So one thing we know from this is that of course it's generally for startup businesses or for expansion, and it's generally given to entrepreneurs as in like new businesses or like those who are small businesses. And when we say small businesses, do know that it doesn't mean that it has to be sole traders or partnerships. No, most businesses are also started as private limited companies, so that also is counted as a small business. So it can also be defined as a form of private equity and a type of financing that investors provide to startup companies and small businesses that are believed to have long-term growth potential. So it's not just financing new businesses or small businesses, but it's also for them. Why do they invest in it? Is because they believe that it has a long-term growth potential. And it's not like it's not risky. No, it is risky for investors, but the potential for above average returns is an attractive payoff to investors. So since they know that okay, it is very risky, but they believe that it had a long-term growth potential and what they can gain a lot if the business succeeds, so that's why they invest in it. And these people who invest, these particular investors for venture capital, we call them venture capitalists. Okay, venture capitalists. Hope you keep that in mind. So it is used to finance projects which face difficulty in securing finance from other sources due to high risk associated with the project, and it is generally a long-term source of finance. And when we say, as we've said, that it was risky for investors, it's not because of it's a new business or small business. It is the fact that they can't get sources from other possible, so they can't get finance from other possible sources like bank loans, or maybe they don't have enough finance from themselves or other sources. They just don't have enough internal finance, and external sources, the other people are might banks might not be too much, you know banks might be concerned with their liquidity position due to the lack of the financial history, and banks might be just the business plan might not be too good to convince a bank. But these venture capitalists will have seen that okay, it is just a risky business, but it has a long-term growth potential, and that's why they invest in such projects. So it is generally offered in exchange of shares or percentage of profits after the project succeeds. So if you take a venture capital, what you have to give in return is basically a percentage of your profits. So unlike loans, you don't have to worry about giving off that, so the repayment, whether your project succeeds or not. No, this is only given off when your project is succeeded, of course. So if your project fails, then of course you won't have to pay off venture capital. But yeah, the basic idea is that you pay off when you succeed. Once you reach that potential that the venture capitalist wanted you to, then you have to either give them a percentage of shares, or in most cases you have to they are offered shares. That is, they become part owners of the company, they become shareholders of the company. So let's look at the benefits of venture capital. It provides funding for small and medium-sized businesses who wish to start operating, expand, or diversify. It can also be used for large investments in technology or complex machinery. So it's not basically just reduced to startup capital or expansion. It is mostly used for startup capital and expansion, but can also be used for purchasing new technology or complex machinery. It provides funding for businesses which will find it difficult to get it from any other sources, as we discussed earlier, that other sources like banks might not be willing to give them loans. So that's where venture capitalists come in. Venture capitalists invest in businesses that have severe cash flow problems in the short term but have good long term prospects as well. It is basically a rescue function from liquidation. So the businesses who have, if we are in cash flow problem, we can go to venture capitalists if they think that okay, they have a good potential, and if they just able to survive from this cash flow crisis right now, they will be able to generate a high enough profit. So that's why they invest in it. Venture capitalists may also provide ideas from their experience and expertise to the business. That's as important advice, guidances, and consultation, and they can also help with financial management. So overall, they just don't give you the finance that you require. They can also provide you some expertise that will be important, that will be helpful in management of your business. Not just normal management; it's basically financial management. So, and lastly, there's no repayment schedule as it is an investment. Therefore, there is no repayment of debts as a cost of taking venture capital. No, you don't have to repay the debts. You just have to give them percentage of profits or shares. So, the main downside, however, is that the investors usually get equity in the company and thus a say in decisions. So, because they become part shareholders of the business, most cases, unless you are giving them the profits that they wanted, because they want to invest in the business, they become well, permanent investors. Perhaps by having the shares, they get the equity in the company, so they also have a say in the decision making of the company. So perhaps they might want you to change some things, and you have to look after their opinion. Like, oh well, the shareholder part, that there's a lot of conflicts and on. But if you are a smart person, then perhaps if they have helped you to get this profitable with their advice and all, if they have given you previously advice, then perhaps it might be a good option to just go with their ideas, because you might have some good profits. But it's not good for some businesses who are like, who want to but who want to take CSR as their objective, perhaps. So in that particular case, it might be a little downside to go for venture capital, because they will mostly go for profits. So if they become shareholders, they will just have some decision makings that will try to maximize their profits but and their dividends. So in that particular cases, when you want to avoid giving control to venture capitalists, you will not it is not an appropriate source of finance. But if you can't have other sources of finance, then perhaps venture capital is a good choice. Moving on, we have crowdfunding. Crowdfunding is a source of finance for unique project or new business venture. In crowdfunding, a business sets up a fund to raise monetary contributions or donations from the public, usually on an online platform. So it is basically for new venture or unique project. Of course, it could have been used for some other purposes, but that's the general uses that it has. And it's just like you use a website and you just raise monetary contributions or donations from public until you reach that particular target. So it's a fundraiser campaign. It makes use of the easy accessibility of vast networks of people through social media and crowdfunding websites to bring investors and entrepreneurs together. And the great part about this source of finance is that it has the potential to increase entrepreneurship by expanding the pool of investors beyond the traditional circle of owners, relatives, and venture capitalists. So thanks to crowdfunding, we don't have just some normal investors like your owners or relatives and your venture capitalists. You can look after some new investors as well. You expand the pool of investors that are available to your business. So with social media, there are a lot of people that can invest in you, and you can just find the perfect investors as well for your business. Each individual takes a small stake by contributing towards an online fundraising target. So those who ever participate in crowdfunding campaigns, they all are investors. They just take a small stake by contributing towards an online fundraising target, and once the target is reached, then if the business succeeds in that particular program that they have invested in, if that it was using crowdfunding for, then whatever the profit that the business makes, a small percentage of that will be contributed to these investors as well. There are, however, restrictions on who can contribute and how much, to protect non-wealthy investors from putting too much of their savings at risk. So otherwise, they might just put all of their savings at risk, and if the business fails, then that's not good for them. So such website regulations are there so that not everyone can contribute, and not every one person can give just whatever all of that they have. Ideas that may not appeal to conventional investors can often get financed more easily. So it's another source of finance where you just can't have bank loans, etc., or even venture capitalists might not be agreed. So in that particular case as well, crowdfunding will be used. It allows a business to gain finance when it would not be possible, as we just said, like bank loans not available or not enough savings. So if they can't have enough investors, or like they don't have enough other sources like bank loans, so in those particular cases, crowdfunding is a good source of finance. It can be used to gain capital for business startup, to buy assets, or to improve cash flow. These are general uses. It is a fast and flexible source of finance. That is, it is quick and cheap as no upfront documents are required. So you don't have to require documents, but this cheap point might be sometimes argued because you know these crowdfunding websites, they do have a sometimes a small fee that you have to pay before starting this campaign. So that might be expensive sometimes, but generally it's not. You don't have to provide that many documents and when you are starting a crowdfunding campaign. It allows new businesses to promote themselves to thousands of potential investors and customers, as it provides a useful opportunity to explain about the business. So thanks to that, you can just, as we said, that you can attract potential customers, investors, and not just investors, your customers as well, as you explain them about the business as well, what you are trying to achieve, etc. And it is also a good way to test the public's reaction to a new product or idea. So if you are using crowdfunding for starting for making a new product, you can just see that how if people are excited about investing in it or not, or if people think that it's just not a good idea for that investment. However, in some cases, if you don't reach your funding goal, any finance that has been pledged will be returned to your investors. So that's a big downside of that. If you just can't reach your fundraising target, then all the funding will be returned to the investors. And another part is that it might bring possible damage to reputation of a company because you have resorted to crowdfunding. So that's a little fun thing, but yeah, investors or banks might think that if a big business is going for crowdfunding, why is it going, is it having cash flow problems? It causes some tension between the stakeholders, and they might just it hurts the reputation of the business generally. But let's hope it not. So crowdfunding might not be a good option for large reputable businesses, but it's generally good for startup businesses or those who are not that much popular but they just want to make a name for themselves. Finally, we have grants, and we are a little low on time, 3 minutes, so let's just move it quick. Grants, when we say grants, it's basically government grants or government aids as well, as you can say sometimes. It is funding for businesses which is often provided by grants giving agencies such as the central government. These are often provided to small businesses or those wanting to expand in developing regions. However, there are certain requirements that need to be met, such as employing a certain number of employees from a particular area. Usually, if these requirements are met, such grants do not have to be repaid. So that's a lot of thing that basically you are just provided these grants for meeting certain conditions, and if you meet these certain conditions, you don't have to repay the bank. So that's good thing if you are having if you want to retain your profit, that is like it does not cut into your profits. That's a big advantage that you can say it has. So it's free money, non-repayable, or no interest will have to be paid, and attractive financial consideration. But when we say free money and all, it just means that it doesn't have to be repaid if you meet those conditions requirements. It is good for businesses who are unable to afford or receive loans. So similarly, all these three resources that we have talked about today, generally for those businesses who just can't afford bank loans or can't attract investors. It gives confidence to banks and investors for giving loan and investing in business in the future, as it validates the efficiency of their business. So not only is a good alternative source of finance when you can't find other sources of finance, it also gives confidence to your banks and investors so that they can finance you later on, as it validates your efficiency. That okay, if the government has given you permission, then okay, you must be a good business. Your activity might be just approved by the government, so they know that okay, later on this business will succeed. It might has good potential, and it will be able to return our loans, our debt. So that's why the banks will also give you loans later on. It is also easier to get more grants once awarded ones. Hence, it is an important complement to existing funds. So sometimes it is said that you can get more grants if you have already had one, so you can just have more funds. But the disadvantages of it may be difficult to receive grants as the eligibility criteria may be too demanding or may have too stringent conditions attached. So not every business can get grants because of the criteria that is attached. Like let's say it has a labor, you have to have certain amount of labor, but the labor cost might be rising, so you can't have a labor intensive businesses. So that could be, so in such conditions you can't receive grants because you can't have more cost to the business. It may be too small or insufficient for particular needs of business. That is of course true. It requires too much detailed information. That is the excessive monitoring of grant users as well. and it may become too reliant on grants and perhaps use it unwisely. So all these are disadvantages and self-explanatory, and we are out of time. Thanks for watching. Allah Hafiz.